Major funding for these programs is made possible by grants from Capital One Bank, New York Community Bank, Eastern Consolidated, M&T Bank, Customers Bank, Meridian Capital Group, Terra CRG, the Witkoff Group, Perfect Building Maintenance, Chase Commercial Term Lending, Chase Commercial Mortgage Lending, Genova Burns. Additional support is made possible by AKA Hotels, Corman Communities, AmTrust Title, Aerial Property Advisors, AVR Realty Company, Bank of America Merrill Lynch, Bank Leumi USA, Briarwood Organization, CBRE, Citizens Bank, Connect One Bank, Colliers International NYC, Collins Building Services, CPEX Real Estate Services, Dime Savings Bank of Williamsburg, Douglaston Development, Levine Builders, Fisher Brothers, Flushing Bank, Friedman LLP, Hendler Real Estate Organization, Hersha Hospitality, HAP Investment Developers, Hodges Ward Elliott Inc., Investors Bank, iFunding, James D. Kuhn Real Estate Center at Syracuse University, Kilroy Architectural Windows, Madison Realty Capital, Matone Group, Mercantile Commerce Bank, New Banks, Newmark Grubb Knight Frank, Optimum Window Manufacturing Corp., People's United Bank, Pulcinelli, Rosewood Realty Services, SJP Properties, Sterling National Bank, Stonehenge Partners, TD Bank, The Continuum Company, the Knackle Group at Cushman and Wakefield, the Meringoff Family Foundation, the Moynihan Group, and these friends.
So here we are. It's the summer of 2016. The people in the UK decide to leave the European Union. There are a lot of other questions over there. We have a Democratic, Republican convention. We have a couple of candidates over there. We have, people are saying, what's happening in the real estate in New York? Is it going to be good? Is it going to be bad? So I've assembled today, and they're both on two different sides over here. I assembled some bankers, and I assembled some business people to provide their insight on where they see the market. My guests today include Jeff Levine, who is the chairman and CEO of Douglaston Development, Levine Builders. J. Philip Rosen, the senior partner at Weil, Gotshal. Ken Mann, who is the president and COO of Dime Community Bank, also previously known as Dime Savings Bank of Williamsburg. And last but not least, Matt Galligan, who is the president of CIT Real Estate Finance. So I have the lenders on this side, and I have the counselor to many people and the real estate developer. How do you see it? You were saying you see it with goggles?
Safety goggles. You asked me, how do I see it? I can't tell you. I have rose-colored glasses. I think that we have to be in a somewhat cautious mode right now as a result of the economic conditions that seem to be prevailing in
But are we going to see all this money from Europe? All these people are going to come here. It's a safe haven to invest over here. Look at the Chinese. They want all this property. The Middle East want the property. There's a change in the tax laws over here.
I think so. I think what you're going to see is that a lot of the investors who are currently investing in the UK are going to take their money and put it in the United States for safety reasons. I also think that our interest rates will stay low for a long period of time, depending upon the election results, hopefully for even longer. But I think that will help bring foreign investment over here. I also think that people are going to, for a period of time, are going to wait to see what happens in the UK and wait to see how it affects the rest of Europe.
But aren't we going to have a little effect perhaps on tourists? these tourists who are living in the UK and Europe, they're not going to be able to come here because it's going to be more expensive for people to be here, which could have an effect on our hospitality business and our restaurant business and so on. I mean, you also own a hotel in addition to
There's no question that a stronger dollar will have negative impact on some of our exports and our hospitality. But, this is a long game. I mean, you talk about the fact that all assets, be they real estate, securities, bonds, are being sought after by flight capital from all over the world for safety. I'm not so sure that safety is necessarily a good thing. I like to tell a story of the sardine traders. Do you all know that story?
Tell us the story. We want.
Three gentlemen are in the sardine trading business. They have shiploads of sardines, and they have them in the harbor at the dock. And one day, one sells it to the next fella at a 5% profit, and the next fella sells it to the third fella at a 5% profit. And these sardines, which originally were $10 a can, are up to $200 a can. One day, while down at the dock, one of the sardine traders says, I'm hungry. I think I'm going to eat a can of sardines. He opens a can. It stinks to high hell. The sardines are all rotten. With that, he calls an emergency meeting of the sardine trading cartel. And he says, guys, we have a problem. The sardines are rotten. What are we going to do? He says, schmuck. Those are not eating sardines. They're trading sardines. So the point of the story is, I don't buy real estate for trading purposes. I buy it for eating purposes. And just because it seems to be safe because you have a world in turmoil doesn't necessarily mean that the cash flows over the long term are going to support the purchase prices.
Which is a perfect way for me to ask Kenny to look at it this way. I mean, the Dime has been really a community bank lending, in the community, specializing more in lending in the multifamily arena. Sometimes, mixed use with, retail downsides, but in general, the multifamily. How do you and the bank, who's done great over the past 152,
all of which you're responsible for.
No. Okay, Ken's only been there about 26. Okay, so
36.
So how do you see it? I mean, just in general.
They sort of follow the demographics. I mean, the regulators are really after community banks, especially these days. I'm sure you all read about it. They're concerned about the rise in values. Most of which they're responsible for through the Federal Reserve lowering interest rates. But so they, the values have really risen quite a bit. But at the end of the day, you look at the demographics, and I think Mayor Giuliani still doesn't get enough credit for what he's done for the city that has made it what it is today. Now, when I started in the business in Brooklyn, it was very much a finance-dominated economy, and it has so turned. Entertainment now, technology, other parts of the economy have grown, and you can see that in Williamsburg along the East River. There were all the technology people, and I think some of the buildings, Jeff, that you're putting up there. They asked me for an article in Bloomberg a couple of weeks ago. What do you do? They always think about millennials as pink hair and nose rings, but I said there's a lot of wealth over there, and they work in the Googles and the Amazons and so forth. It's not a homogenous group. So I mean, we put a name on it, but it's not a homogenous group at all. But really, circle back to your question in terms of the real estate. And even there, I think Jeff would recognize too. There are different classes of real estate. You've got the the $1,000, $1,100 units, and then you've got the $3,000, $4,000, $5,000 units, so different sectors of the market as well. But I think as long as the city continues to be an attractive place, those places get filled up. Little softness somewhere in there, but should be good.
Well, there's no question that banking has been severely impacted by regulation, and some of the regulations you just referred to, HVCRE being one that most impacts the real estate business. Dodd-Frank that keeps us occupied and is very
It helps
expensive.
people like Phil,
Thank God. Very happy with
Right.
that, but I hope it goes away anyway. So.
And I read in today's journal about a Pittsburgh-based bank, about a $20 billion bank that was merging with a Southern bank. And there were two reasons for that. Low interest rates, they couldn't make any money, and they were trying to spread the regulatory burden. So it's just a fact of life, and I would hope that we would look at Dodd-Frank with a discerning eye.
But you know, when you're in a period of we talk about the millenniums, which is one. Then there's this Generation X, and then there's the other generation of the baby boomers, which I would say everyone sitting in this room is over there, and there's different requirements, and baby boomers, people. Some of them are moving to Florida, but many of them want to stay with their families over here. That's why, Heinz is building with this Wellwood company on 56th Street, a luxury.
Yeah, but in all candor, that has nothing to do with baby boomers, because I'm also in the independent assisted living business, primarily in Arizona.
I'm talking, the show's more geared to New York, not...
No, but in New York, we're speaking about the new facility being built. That will appeal, assisted independent living in general, appeals to people, since we're all aging better, in excess of 80 years old. And baby boomers are now only approaching 70. So it's really not baby boomer oriented. It's to that great and silent generation, that's the ones, our parents who were in the Second World War, who are now needing those type of services. Baby boomers have aged more healthy, and while they might look to a retirement community, and they might actually have what we'd almost call a naturally occurring retirement community, because in some of our multifamily jobs, they are moving from the residences that they had in the suburbs, whether in Jersey or Westchester or Long Island, and they are looking to take advantage of the lifestyle and amenities of urban living, much in some ways like the millennials, where they can either still walk to work or walk to theater or walk to restaurants. So there's a movement on both sides, that Generation X and Y factor, as well as the front edge of the baby boomers who are approaching that retirement age right now.
We have friends who actually grew up, we lived nearby them out in Summit, and they moved to, he retired, they moved to Austin, Texas, and they bought a condo in Jersey City, and they're here, May until October.
And that's the situation, that people want to be near their family, so they are renting apartments, or they're buying a condo or something like that. How do you see it? I mean, you have clients from around the world, but your specialty is real estate and M&A. How do you see the market?
So the interesting thing is that everybody's talking about the slowdown, a slowdown in the market. On the other hand, you and I sit on a committee of a not-for-profit institution, and we just entered into contracts to sell 2 properties in Midtown Manhattan for terrific pricing, and I think that one of them is a vacant piece of land where we're selling for $1.5 million per parking spot. It's used for 6 parking spots. I think the market is changing, but I don't think it's the entire market, number one. Number two is I think that there are parts of the market that are still getting better and better. And you look at some communities like the Village, Soho, like Williamsburg, that you see record numbers and you see great construction that's still going, and that's a good thing.
You take other markets like I do know that luxury retail is not doing well.
Yep.
In New York, it's hurting today. Madison Avenue, there's a lot of vacancies. It's being hurt, and if the dollar gets stronger for us and weaker for the Europeans, you're not going to see them spend that type of money when they come here in the retail environment over there. Soho, which is doing well, the retail stores are hurting, and certain landlords are finally sitting down and saying to themselves, I can't get that rent that they projected because it was unrealistic. Now, so you have a big exposure, or you've gone into, you like Jersey City. I like Jersey City also, but I think it's the question of convenience of transportation is very important.
Well, I mean, that's a prerequisite to be around some mode of transportation that can get you back and forth to work. As it relates to the high-end retail, I wonder, and I'm not saying that I believe this, but I wonder whether the depreciation in the pound will hurt it as much as we think here. Because these people that are spending on Madison Avenue are spending such big dollars, they have deep pockets. And they come to New York, and it's a form of recreation to go to Hermès or some of these stores and, drop $1,000, $3,000 on a purse.
Yeah, retailers, if you've read it over the holidays, the online purchase is going to have a big effect as well. It's not just Brexit.
No, there's
We
no.
did a show on that.
A couple of months ago, we did a show, and I think Phil brought up a very interesting thing. One day he was writing into this. Tell the story.
Yeah, so we represented a number of the industrial companies that have been sold for record numbers, and so I got very into the industrial/distribution facility business. I drove down. I always like to investigate my client's business. I'm not somebody who just sits in my office and read about it. So I drove on the Garden State Parkway and New Jersey Turnpike and stopped by a good number of distribution facilities straight down the row. And visited them just to see what's going on. I was mesmerized. I went to the Amazon facility, and I saw there was 3 or 5 employees. Everything is automated, and it's a giant facility.
What 1.2
That's a
million
business.
square feet.
Wow.
That's a business.
Right, but we're also talking
And
about.
they spawn facilities around that.
All around.
Okay, Starbucks, we financed one of these 1.2 million square foot facilities in York, Pennsylvania, which, there you talk about transportation being important, but all the major roads come across so that within 24 hours you can get to Boston, Washington, New York, Chicago, and we anticipated that Amazon was going to take this particular 1.2 million facility. It was built spec, and it happened that Starbucks had some kind of roasting plant close to it, and lo and behold, they took the facility.
It's an amazing thing, and we spoke about this, don't need to do it again, but the transformation of industrial space to both distribution facilities, not just for the online retailers, but for the regular retailers who have online operations. But also there's different parts of the industrial market, such as in places where you're building in Williamsburg and Long Island City, where you're transforming industrial facilities to beautiful residential buildings. So there's a lot of transformation that's going on there.
As most people know, in all of my seasons, I literally stay away from the politics. But I think at this time, especially with what happened in Europe over here and the presidential election over here, all of this, you're in a pot. And the question is the chemistry that's going to come out of the pot. How do you look at the presidential, 6 months from now, after the election? How do you see that with regard to investors, banks, and other people looking at the market? Ken?
I'm going to ask Jeff to lend me his safety goggles for that one. I really don't know the answer.
That's funny.
Well, if I could talk about politics on a more granular level, since you want to talk about New York City. So obviously everybody here is aware of the fact that much of the residential development in New York City, including the affordable housing components, were in part due to this 421A tax abatement, which has been in place for, 30 years now. It's expired, as we all know now. It expired essentially at the end of 2015. So we have a new administration of de Blasio, which stepped in and was striving to make the 421A abatement more beneficial to the affordable housing sector, that along with its quality housing regulations. And unfortunately, as a result of the issue between organized labor and open shop labor, there was no agreements made. So in 2015, you as bankers, I'm sure know the numbers, there were 57,000 units of housing permitted in New York City due to 2 items. Number 1, the anticipated expiration of the tax abatement, and number 2, the abundance of finance available as a result of the strength of the condo market. So we all know that up until 2015, land prices went through the roof because the bankers, the developers all believed in the strength of the condo market. So what's actually happened, though, is the condo market has kind of left the building, certainly at the uber luxury and luxury levels, for many reasons. What remains is the commodity level, condos under, say, $2,000 a foot, which exists primarily in northern Manhattan, in Williamsburg, in
Or,
Brooklyn and
or
Queens.
conversions.
Or
of,
conversions.
right.
So there's a problem. So you had 57,000 units permitted. You have many of them luxury rentals, but most condos. Now you have a situation, you fast forward to 2016, after the banks have lost confidence in the uber luxury and luxury condo market, after you have the expiration of tax abatement, and in the first 6 months of 2016, you've had less than 5,000 units of housing permitted.
And the same thing has happened in the value of land. The pricing of land, nobody wants to buy it.
Well-
I mean, you have a son who's in the investment sales business, and the land prices have shrunk down because
true.
you don't have the tax benefits. And how are you as a lender going to look at a deal without tax benefits?
Well, I mean, if you're in it for $200 a foot, you can underwrite it, right? So it's really a question of what the land prices are. And I agree with you, the land prices were getting ridiculous, somewhere between $700 a foot to $1,000 a foot. When looking back to '07, they peaked at $400 a foot. So, doubling.
But in the same manner, I was with somebody. Ken's bank had a very nice event last night, and somebody said to me, one of your young bankers, and he said, when people tell me that there are cap rates in the Bronx of 4%, it's unrealistic. It's a different market. Not everybody. Transportation. I think you gave a great comment a couple of months ago when you were on the show and we were talking about the Bronx. You said, "Yeah, I'm developing, but there was a murder right next door."
Well, no. Listen, I do quite a bit of affordable housing development in the Bronx, and it's not because I simply only want to do affordable housing development in the Bronx. It's because that at this time, the market rate for rental doesn't exceed $35 a foot, and frankly speaking, without subsidy, you cannot afford even open shop to build new residential construction with those kind of rents. You need, in a world that you have a tax abatement, which we unfortunately for the moment don't, although I do believe that our elected officials both at the city and state level will wrap their heads around this before the next legislative cycle. I believe that we will get the tax abatement back because otherwise you will not have both market rate residential rentals or affordable. But again, I cannot build in the Bronx at $35 a foot without subsidy. Once you start getting north of $50 a foot, if you have acquisition prices less than $200, depending on how much more revenue you could achieve from the $50 up, then you can start to pencil out deals that return at about a 6% cap rate.
What's interesting about what you said, and going back to something Matt said before, is you can see the direct effect of government regulation on different parts of our economy directly. It's not even like, you have to wait or it's an indirect effect. The 421N tax abatement disappears and you go from 50-something thousand units being built to 5,000.
And
direct.
But let's also look at the rentals. A borrower that Ken may have who has got a loan a couple of years ago. There hasn't been a rent increase in 2 years under de Blasio's program. But the real estate taxes have gone up, the water and sewer has gone up, the insurance has gone up, and I don't want to be the spokesman for the rent stabilization board, but when
they're suing, they're suing. You don't have to be the spokesman.
No, but their advertisements are very accurate. How can we put money into this property if we don't get additional rents? Our expenses are going up.
That's how properties deteriorated back in the 60s and 70s.
Yeah.
They forget that. It seems like a long time ago, but for some of us that have been around a long time, you remember those things.
But, government involvement in housing, if you go back to the whole Fannie Mae program of trying to facilitate lower economic purchasers of housing by relaxing the regulations for borrowing, that's frankly what led to the boom and the bust of Lehman. So we go a step further. Right now, EB5, which is fueling a lot of development, certainly in the New York metro area, that is under review, and we don't know what the legislative outcome of that will be on a national level. So there are a number of issues. Community Reinvestment Act, the CRAs, which result in the sale of our tax credits, that is something which is always under review.
You bring up an interesting topic. I know Matt has provided financing on projects that have had this EB-5, which is the immigration program where somebody can buy a green card for $500,000. Phil, how do you see the EB-5's effect?
So
I mean, you have clients on all sides of this coin.
yeah, listen, I think EB-5 was a great method to give an injection into parts of the real estate development market that needed it at the time. And I think that if the EB-5 program continues, it will be another injection. And I think that's a good thing for real estate development, at least in my mind.
As a lender, how do you look at the EB-5?
Well, of course, it's well subordinated to us.
Yeah.
So it's a good thing. I mean, the equity requirements today are very, very high. And I think it's a good way for a developer to get a bit of a break on the cost of equity.
How does a smaller bank like the Dime compete in this market? How do you look at that?
Well, for Dime, because we've had such a long history in the market, it's a broker-driven market. And Dime last year, three-quarters of the way through the year, we were the fourth largest multifamily lender in the city, behind some pretty big names. Signature, I think, among them, and J.P. Morgan, think New York Community, then Dime. But, it's a commoditized business. We compete on rate. We don't have a lot of overhead.
How do you look at it? There's a lot of big discussions in the papers all the time saying that the banks should, they should, in addition to be doing commercial real estate, they should be doing C&I business, commerce and industry.
Well, that was funny because one of our competitors just recently abandoned the multifamily market, and he said, we're not going to do multifamily lending in New York City any longer. Now we're going to do C&I lending, and 2 weeks later, there's a press release that comes out that C&I loans have the highest delinquency rates since 2008. So, the regulators sometimes, good intentions, but they'll drive these community banks out of what is a really good sector still into something that could be a lot more volatile and higher losses, obviously, and something that not many of us know. So.
Right, which I think Phil and both Matt and I could say the C&I lending is much more treacherous.
Of course, yeah.
Than putting a solid piece of real estate. Lending
I'll
on
tell you,
inventory.
What I always tell people when they ask me which is the safest investment, clients come in from overseas, I tell them my almost 100% of my investment portfolio, my personal, is in multifamily all around the country, different sectors, different times, different aspects. But I think for me, that's where safety is. Although I do put some money into commercial office and retail, and recently into the industrial space.
Well, outside of New York, you can't underwrite them all like you underwrite New York City multifamilies, and I know you know that because it's different. Like I say in New York, they're not putting any more land up. So
yeah, it's true.
There's only so much land that can go around. They're going higher, but there's only so much land to build on.
So the only other thing I wanted to add was, with the changes in the world, I think that there's a misnomer that's been out there for a very long time, and we've all lived through 4 cycles.
This year.
The misnomer is that when people talk about bubbles being created in different economies and, is the bubble going to burst? The fact is the real estate business is more than one business. It's got more than one cycle. It's got more than one bubble all across the country, all across the city. And so you can never group it all together, at least in my mind.
So I think in summation, we have to see elections, legislation, other circumstances. There's a lot of things stirring the pot. And, we come back in December, it'll be a different time.
You bet.
Different market.
Sure.
I'd like to thank Jeff, Phil, Ken, and needless to say, Matt. And I'll see you next week.
Thank you, Michael.
Thank you.
Thank you.